Gold and silver are under pressure post-jobs, and as the two-day G20 summit kicks off in Germany, what can we expect from the metals as we wrap the week here? Joining us now is Kitco's Global Trading Director, Peter Hug. Peter, welcome back.
It's good to be here, Daniel.
Yeah, as we're speaking, gold trading at a 7-week low. The upbeat jobs report this morning didn't help the metal. So what close are you looking for right now, Pete?
Well, I've totally discounted the jobs report. I don't even think the Fed's looking at that anymore. It's more psychological. What I saw in the jobs report was actually bullish the metals in the context that the wage pressures are certainly not rising, and I think the Fed's primary focus is their inflation target, and I'm still skeptical whether they're going to meet that target anytime soon. But on the metals, as you know, about 3 weeks ago, we suggested, or at least I did in my blog, that unless gold broke up through 1255, I would not engage in this market. And, and it's been sort of on a downtrend ever since. I mean, if you're looking for support levels, obviously, my first support level we bought this morning at was around the 1208 level. There is some minor resistance there with some obviously psychological resistance at the figure 1200. At these levels here, I don't think it's going to wash out anymore today. I don't think it'll break through the 1208 level today, but we'll have to see on Monday if there's any follow-through selling on this move.
And we're going to talk, so we're talking gold now. I'm going to ask you silver in a bit. But first, let's look at physical demand. We're seeing anemic physical demand, at least for gold sales. Silver might be a different story after that flash crash last night. But what are you seeing on the gold front here, Pete?
Gold's been fairly steady. I've not been disappointed with gold demand. It's obviously down from the same period last year, but gold's been relatively steady on the demand side. There's not a large accumulation of secondary gold in the market as there is with silver. Gold's been, I wouldn't say robust, but certainly not an issue from the perspective of massive liquidation into the physical market that is causing dealers to refine out the lots. So, gold is okay. Silver has been hit relatively heavy with physical supply coming into the market over the past 2 or 3 months. But again, as silver broke down through $16 yesterday and obviously today in the mid-15s, we're seeing a considerable pickup in silver interest at these levels.
Right. And how are you playing that silver-gold ratio, Pete?
Silver's at approximately 78 ounces of silver to an ounce of gold. And, I like silver relative gold. So there's 2 ways to play it. One, you can just go net long silver and take the risk that the market doesn't wash out further and gold doesn't break 1200, which would put silver in the 14s. Or you can play it more conservatively by playing the ratio. And, you can sell the ratio at 78 and hope for, the silver-gold ratio to come back into line around 72. And, if you look at what's going on in this market, it's a two-edged sword. So, if the Fed raises interest rates, you would expect that to be negative for the metals, and I think that's psychologically what's in this market. But that's going to be problematic for the equity markets. And, I'm not sure how aggressive the Fed is going to be able to be going forward. I think the equity markets might be running out of steam. On the reverse, if there is some equity issues, the Fed is likely to back off. So, when you look at silver, it's an industrial metal. So you have to look at it, okay, if the economy is as strong as people suggest it is, which indicates higher Fed rates, then the industrial demand for silver should pick up, which in my opinion makes silver cheap relative gold. In the reverse scenario, if the economy really is not as strong and the Fed lowers rates, that's good for the metals complex in general as they ease back. Right. And if that happens, then silver relative gold is still inexpensive. So at 78 to 1, I like silver relative gold.
And we don't have much time left, but I'm really curious to know what you feel was behind that flash crash. Do you think it was indeed a glitch? Do you agree, or do you think it's something bigger there?
Yeah, I'm just assuming whoever's pulling this trigger has got, can chew gum and walk at the same time. I mean, anybody that tries to unload that quantity at the opening of the Tokyo market is out of their mind. So I'm guessing it was a glitch. But if it was a broker liquidating a client, the broker doesn't care. He's just going to blow the client out. But the client is obviously not going to be too happy. It probably cost the client an additional $15 million to meet margin because of that liquidation.
And I'm sure your phone was ringing off the hook, as was mine. Peter Hug, thanks so much for joining us.
You're welcome.
And stay tuned. We have Vince Lanci to talk more about silver's flash crash up next on Kitco's Gold Report.